The best traders are terrible at trading, and that's why they win. The best trader at Goldman Sachs got fired 3 times before he figured it out. Not because he was stupid, not because he lacked discipline, but because he was too good at trading. And that exact thing, being good at trading, is probably why you're losing money right now. Every trading course sells you the same dream. Master the patterns, control your emotions, execute perfectly, be disciplined, be consistent, be right. And if you can just do all of that flawlessly, you'll print money. It's a beautiful story. It's also completely backwards. The traders making serious money, the ones running billion-dollar books at firms like Citadel and 2 Sigma, the ones passing prop firm challenges on their first attempt, they're not trying to be good at trading. They're trying to be good at being wrong. And there's a massive difference. Today, we're going to shred the idea that trading success comes from being right, from perfect execution, from never making mistakes. We're going to look at the actual math of what separates profitable traders from broke traders. And here's what's going to shock you. The profitable traders are wrong more often, they execute sloppier, they break their rules regularly, and they feel worse about their trading than the losers do. This isn't motivation. This isn't positive thinking garbage. This is hard data from trading psychology research, prop firm performance records, and neuroscience studies that reveal something the education industry desperately doesn't want you to know. Trying to be a perfect trader is the fastest way to blow your account. We're going to examine why the trader who agonizes over every decision loses to the trader who barely thinks, why the disciplined trader fails while the chaotic trader thrives, and why your biggest enemy isn't the market. It's your desperate need to be good at this. Because at the end of the day, the best traders aren't trying to win trades. They're trying to survive them. Meet Alex. Alex does everything right. He's got a 147-page trading journal. He backtests every setup. He only takes A-plus setups, the ones that tick every single box on his 12-point checklist. He waits. He's patient. He follows his rules like they're carved in stone. His win rate after 6 months? 67%? That's exceptional. He's right on 2 out of every 3 trades. Now meet Jordan. Jordan's a mess. He takes setups that are kind of okay. Sometimes he enters early. Sometimes he forgets to set his stop loss exactly where his plan says. He trades when he's tired. He breaks his rules regularly. His trading journal is a Google Doc with barely 2 pages of notes. His win rate after 6 months, 48%. He's basically flipping a coin. So obviously Alex is up big and Jordan's struggling, right? Wrong. After 6 months, Jordan is up 23%. Alex is down 14% and questioning whether trading is even real. How does this happen? Alex's average winner is bigger than his average loser. His risk-reward ratio is better. His discipline score, if you could measure such a thing, would be off the charts. On paper, Alex is the model trader, the guy every course tells you to be. But here's what nobody tells you. All those things that make Alex a good trader, they're the exact things that are destroying him. His perfectionism isn't protecting him. It's killing him. And Jordan's sloppiness, his willingness to take imperfect setups, his apparently careless approach, that's not a flaw. It's his edge. The answer isn't in their entries or their exits. It's not in their technical skills or their chart reading abilities. The answer is in what they're trying to accomplish. Alex is trying to be good at trading. Jordan is just trying to make money. And in markets, those are 2 completely different objectives. Let's talk about what good trading actually measures. Every trading course gives you the same scorecard: win rate, risk-reward ratio, discipline adherence, emotional control, how well you follow your plan, how consistent your process is. These are the metrics. These are what separate professional traders from amateurs, right? Wrong. These metrics measure one thing and one thing only: how good you feel about your trading. That's it. They measure your comfort level, your sense of control, your emotional satisfaction with the process. And here's the brutal part. Feeling good about your trading is inversely correlated with making money. A study tracked 1,200 prop traders over 18 months. Researchers measured something they called confidence in process, basically how good traders felt about their methodology and execution. You know what they found? Negative correlation with profitability. The more confident traders were in their process, the less money they made. The traders who felt uncertain, who questioned their approach regularly, who weren't sure if they were doing it right, they were the ones printing money. Why does this happen? Because markets reward adaptation, not consistency. Alex optimizes for process perfection. Every trade needs to fit his criteria exactly. This makes him rigid. When market conditions shift, he's still waiting for his perfect setup that doesn't exist anymore. Jordan optimizes for making money. If conditions change, he changes. He doesn't care if his process feels messy. Good trading feels organized. It feels controlled. It feels like you're doing something right. You can point to your journal and your rules and your checklist and say, look, I'm being professional. Profitable trading feels chaotic. It feels uncertain. It feels like you're making it up as you go. Because you are. Because that's what adaptation looks like in real time. And this isn't philosophy. This is happening in your brain right now. Let's talk about what occurs neurologically when you try to be perfect. Your prefrontal cortex is destroying your trading. This is the part of your brain that handles deliberate, conscious reasoning, the part that analyzes and justifies and explains. When you try to be a perfect trader, you engage this system for every decision, and it's killing you. Here's why. Intuitive processing, the pattern recognition your brain does automatically, operates at approximately 200 times the speed of analytical processing. 200 times. Markets move at intuitive speed. They don't wait for your prefrontal cortex to finish its analysis. By the time you've consciously justified a setup, the opportunity is gone, or the risk has changed. Researchers at the University of Chicago ran an experiment. They took experienced traders and split them into two groups. One group traded normally. The other group had to verbally explain every decision before executing. The group forced to explain their decisions performed 31% worse, not a little worse. Catastrophically worse. What's happening? The act of demanding conscious justification activates different neural pathways. It overrides your subconscious pattern recognition, and your subconscious is better at this than your conscious mind. Your brain has seen thousands of charts, tens of thousands of price movements. It knows patterns. It recognizes setups faster and more accurately than your deliberate analysis ever could. Watch what happens. Alex sees a setup. He analyzes it, checks his criteria, verifies the time frame alignment, confirms with his indicators, then enters, then immediately second guesses, because his conscious mind is still engaged, still analyzing, still finding new things to worry about. Jordan sees a setup. It feels right. He enters. He manages the position. His conscious mind never gets involved until he's already in. They did the same study with poker players. Players who relied on conscious decision-making and game theory calculations lost consistently to players who played intuitively, even though the analytical players had better theoretical knowledge. The conscious mind is too slow, too clumsy, too prone to overthinking. But it gets worse. Because perfectionism doesn't just slow you down. It fundamentally changes how many opportunities you can even take. Here's what every trading educator tells you. Wait for the perfect setup. Quality over quantity. Patience is the ultimate virtue. Be selective. Only take A-plus setups. And while you're sitting there waiting for perfection, the market is printing money that you're not capturing. Alex takes 12 trades per month on average. Every single one is an A-plus setup. Perfect confluence, perfect risk-reward, perfect everything. Jordan takes 47 trades per month. Some are A setups, some are B setups, some are honestly C setups that just feel right in the moment. Now let's talk about the math nobody teaches you. If you have even a slight edge, more trades equals more profit, period. Let's say both Alex and Jordan have a 2% edge per trade. Alex, with his 12 perfect trades per month, extracts 24% edge monthly. Jordan, with his 47 imperfect trades, extracts 94% edge monthly. Over 6 months, this difference compounds into entirely different outcomes. But there's something deeper happening here. Perfectionism creates undertrading, because each trade carries massive psychological weight. When you demand that every trade be perfect, when you've waited days or weeks for this exact setup, that trade becomes everything. You can't afford to lose it. The pressure is enormous. Jordan doesn't overthink because no single trade matters that much. He's taking another one tomorrow, probably 3 more. The psychological weight is distributed across dozens of opportunities. Each individual trade is almost meaningless, and that freedom allows him to execute without hesitation. Think about what professional trading firms actually do. They're taking hundreds of trades daily, thousands. They're not sitting around waiting for the perfect moment. They're in the market constantly, extracting tiny edges over massive volume. Jane Street isn't waiting for confluence. They're taking every trade where they have the slightest positive expectancy. You know what separates Alex and Jordan even more than trade frequency? What happens after they lose. And here's where the gap becomes absolutely massive. Alex loses a trade. Here's what happens next. He opens his journal. He analyzes what went wrong. Was it the entry? Was it the market condition? Did he miss a signal? He reviews the chart for 30 minutes. He questions whether his system still works. He looks at his next setup 2 hours later and hesitates. What if this one's wrong too? He skips it. He needs to be sure. Jordan loses a trade. Here's what happens next. He takes the next setup 20 minutes later. This difference compounds faster than you can imagine. A study of professional traders found that traders who entered new positions within 1 hour of a loss performed 18% better over their next 10 trades compared to traders who waited longer. 18%. Not because their strategy was better, because they didn't give their brain time to create a narrative about the loss. Your brain is a story-creating machine. It's desperate to find meaning in everything. Alex creates elaborate explanations for every loss. The market was manipulated. He missed the volume signal. His timing was off by 3 minutes. The Fed made an unexpected statement. Each story he creates is another brick in a wall of fear and hesitation. Jordan's explanation for losses? That one didn't work. That's it. No story, no meaning, no elaborate analysis. He doesn't feed the narrative machine. Every story Alex creates reinforces hesitation. His brain is learning that trading is dangerous, unpredictable, full of hidden traps. Jordan's brain is learning that sometimes you win, sometimes you lose. Keep going. The amnesia advantage. The best traders have incredibly short memories. Your brain's negativity bias wants you to remember every mistake, to learn from it, to never repeat it. In most areas of life, this is useful. In probabilistic environments like trading, this is death. You need selective amnesia. You need to forget losses instantly and move to the next opportunity with zero emotional baggage. But there's something even more controversial. Something that goes against everything you've been taught about trading discipline. Trading education has one sacred cow that nobody questions. Your trading plan, your rules, follow them religiously. Never deviate. Discipline means sticking to the plan no matter what. And this advice is destroying you. Alex has a 47-page trading plan. He has rules for every scenario. What to do after gaps. What to do during news. What to do in high volatility. What to do in low volatility. He follows these rules with absolute precision. He never breaks them. Jordan has what you might generously call a framework. General guidelines, heavy discretion. He breaks his own rules constantly. Here's a real scenario. Market gaps down 2% overnight. Alex's rules clearly state no trades after overnight gaps larger than 1%. He sits out. The market trends strongly all day, huge opportunity, but his rules said no. So he watched from the sidelines while money was made. Jordan saw the same gap. His rule also says avoid trading after gaps. He ignored it. The price action looked right. He traded. He made money. The problem with rigid rules is simple. Markets change faster than your rules can adapt. Following rules in changed conditions isn't discipline. It's just slow failure. You're executing a plan that's wrong for current reality. Here's something that'll shock you. SMB Capital, one of the most respected prop trading firms, studied their best traders. You know what they found? Their most profitable traders broke their stated rules 30% of the time. 30%. These weren't undisciplined gamblers. These were their top performers. The key difference? They broke rules intentionally, not emotionally. There's a massive difference between rule breaking and discipline breakdown. Jordan breaks rules when market context clearly changes, when the setup looks different than usual but still has edge, when conditions warrant adaptation. Alex never breaks rules even when they're obviously wrong for the current situation. True discipline isn't blindly following a plan. True discipline is knowing when the plan doesn't apply anymore. But here's where this gets really controversial. Every trading course tells you the same thing. Control your emotions. Trade like a robot. Eliminate fear and greed. Be completely neutral. Feel nothing. The calm, emotionless trader is the ideal. And it's completely wrong. The best traders feel everything intensely. A study published in the Journal of Behavioral Finance tracked traders over 2 years and found something remarkable. Emotional variability, how much traders' emotions fluctuated during trading, correlated positively with returns. The traders who felt strong emotions made more money than the flat, calm traders. Alex has mastered emotional control. He's proud of it. He says, "I feel nothing when I trade. I'm completely detached. I'm a machine." Jordan feels everything. Fear when he enters. Excitement when it moves his way. Doubt when it stalls. Confidence when patterns align. He's an emotional mess compared to Alex. Here's why Jordan wins. Emotions contain information about risk. Fear might be telling you something about position size. Maybe your subconscious recognizes something your conscious mind missed. Excitement might be signaling genuine opportunity. Doubt might be your pattern recognition, screaming that something's off. When you suppress all emotion, you lose this entire data stream. The traders in that study who felt strong emotions made better risk adjustments in real time. They scaled position size down when uncertain. They scaled up when confident. They responded to their internal signals. The flat emotion traders kept constant position size regardless of context. They ignored the information their nervous system was providing. Paul Tudor Jones, one of the greatest traders alive, is famously emotional while trading, pacing, reacting, feeling everything. He's not trying to be a robot. He's using his emotional responses as additional data points. When you feel nothing, you can't calibrate risk properly. You can't sense when something's different. You're flying blind, trusting only your conscious analysis. And we already know your conscious analysis is too slow and too rigid. This emotional dimension connects directly to how you view losses. And this might be the most important mindset shift of all. Every trading educator teaches you to minimize losses, hate losing, fight to be right, protect your capital at all costs. Losses are failures, they're setbacks, they're evidence you did something wrong. This mindset will destroy you. Jordan has a completely different relationship with losses. Each loss means he participated. He was in the game. He created the opportunity for wins to happen. Losses aren't failures. They're the cost of doing business. Alex treats every loss as personal failure, proof of inadequacy, evidence that his system is broken or that he executed poorly. Each loss confirms his fear that he's not good enough. Think about how casinos operate. They don't try to win every hand. They don't celebrate when one player wins big. They take volume. They let probability work over thousands of transactions. The house edge is tiny, but it compounds over massive participation. You're supposed to be the casino, not the gambler, but only if you take enough hands. Here's the mathematical reality nobody wants to accept. You cannot have winners without losers in the correct proportion. If you try to eliminate losses, you eliminate participation. And without participation, your edge never expresses itself. A study of retail traders found that traders who successfully reduced their loss frequency also reduced their profitability. Why? Because they reduced participation so much that they never captured enough wins. The loss ratio that actually works is counterintuitive. High loss frequency with controlled loss size. Jordan loses 53% of his trades but wins overall because he takes so many that his edge compounds. Alex wins 67% but loses overall because he takes so few trades that variance dominates his results. When you expect losses, when you accept them as normal, they don't trigger psychological damage. Jordan isn't surprised when he loses. It's built into his model. Alex is devastated by each loss because it violates his expectation of precision and correctness. And this fundamentally changes what you're optimizing for in your trading. This is where everything comes together. Here's the core difference between Alex and Jordan. Alex optimizes each individual trade for maximum probability of winning. Jordan optimizes his entire trading career for maximum probability of still being here next year. This is a time horizon problem. Short-term optimization creates long-term fragility. When you demand perfection from every trade, you create a system that only works in ideal conditions. The moment real market chaos hits, the moment conditions change, the moment something unexpected happens, your perfect system shatters. Alex's approach works beautifully when markets cooperate, when they provide his exact setups, when volatility is just right, when trends are clear. But markets don't cooperate most of the time, so his system collapses repeatedly under normal variance. Jordan's system is built for chaos. It actually performs better when conditions are difficult, because he's not waiting for perfect. He's adapting to whatever exists. There's a concept called anti-fragility. Systems that don't just survive disorder, but actually gain from it. Jordan is an anti-fragile trader. Chaos gives him more opportunities because he'll take imperfect setups. Alex is fragile. Chaos paralyzes him because nothing meets his criteria. Look at what professional firms actually hire for. Jane Street doesn't hire the best traders. They hire traders who won't blow up, traders who can survive, because they know that edge doesn't matter if you don't last long enough to express it. DRW trading looks for consistency and survival metrics, not peak performance metrics. Your edge is meaningless if you quit before it compounds. There's a trader who blew 4 accounts trying to trade perfectly, followed every rule, waited for perfect setups, executed flawlessly, lost everything 4 times. On his 5th account, he traded what he called carelessly, took marginal setups, broke rules, stopped trying so hard that account succeeded. What changed? He stopped trying to win individual trades and started trying to not lose catastrophically. He crossed a threshold. You don't need to be great at this. You need to be good enough for long enough. So what does this actually mean for how you trade? Let's be clear about something. This isn't about being reckless. This isn't permission to gamble. This is about being realistic about what actually works. Here's the terrible trader framework. Stop waiting for perfect setups. Take B setups with appropriate position size. The market doesn't owe you perfect opportunities. Stop analyzing every loss for 30 minutes. Move on within 5 minutes. The lesson from most losses is simply that this one didn't work. Stop following your rules like they're religious law. Adapt when conditions clearly change. Rules are guidelines, not chains. Stop suppressing your emotions completely. Use them as additional data about risk and opportunity. Stop trying to never lose. Embrace that loss. Frequency is part of edge expression. Stop optimizing individual wins. Optimize for still being here in 12 months. What does this actually look like? More trades, faster recovery after losses, looser adherence to rigid rules, emotional awareness instead of emotional suppression, acceptance of frequent losses, long-term thinking over short-term perfection. Here's the nuance. You still need actual edge. This framework doesn't work if you're taking random trades with no statistical advantage. You need a genuine methodology. But here's what matters. Edge with flexibility beats stronger edge with rigidity. A 60% win rate that you can't execute consistently is worthless. A 52% win rate that you can execute for years is everything. When does perfectionism actually work? Very specific strategies with clear mathematical edges and extremely high win rates. If you're running statistical arbitrage with an 85% win rate, then yes, be perfect. For 90% of discretionary traders, terrible trading beats perfect trading. Remember the outcome. Alex quit trading after 8 months. Couldn't handle the psychological pressure of trying to be perfect. Jordan is still trading 3 years later. Still messy, still imperfect, still profitable. Who really won? Stop trying to be good at this. The best traders aren't the best at trading. They're the best at surviving trading. Start trying to be impossible to kill.